So it's kind of an idea. If I'm going out on what I call a QuickBooks setup or training, the first thing that I'm trying to do is set up the chart of accounts. I'm trying to understand your business and what accounts you need to show in your chart of accounts. The chart of accounts kind of encompasses both the balance sheet and the income statement. So it's got assets, liabilities, equity, revenue, cost of goods, and expenses. And I'm trying to design those to match your business. The two basic financial statements that people are familiar with are the balance sheet and the income statement. The people understand the income statement the best, it makes the most sense to them. It shows the revenue and it shows the expenses it took to produce that revenue. The goal of a business is that the revenue exceed the expenses, and that's called profit. The two reports, again, the balance sheet and the income statement, have elements to them. And the balance sheet, there are three basic elements: the assets, which is equal to the liabilities, and the equity. On the profit and loss statement, the elements are revenue, cost of goods, giving you a gross profit, overhead expenses, and then other income and other expenses. Those other income and other expenses might be things that aren't normal part of operation. The results that are being reported in the profit and loss or the balance sheet are a cumulative result over time. If I want to see what went into that revenue number, then I go to the general ledger. And I can zoom in on the revenue, and I can get a detailed listing of who I received the money from or who I invoiced for that revenue. So a general ledger is the detail that supports a detailed listing of all the transactions that supported a number on the profit and loss or balance sheet. Accounts receivable is the money that you've earned that you haven't collected yet. So I've created an invoice for a client. That invoice, when I created that invoice, that produced revenue. Again, on an accrual basis, that's when I recognize the revenue. On a cash basis, I don't recognize it until I collect it. When I collect it, it reduces receivables and increases cash. The revenue piece of it is gone. When you're looking at your chart of accounts, when you're looking at the balance sheet and the profit and loss, you're looking at financial accounting. You're looking at results of operation. There's another type of accounting which is called cost accounting. Cost accounting is being more analytical as to what your income structure look like. It's looking at what costs will vary with sales and which costs remain fixed. And so it's kind of looking at your business from a different viewpoint, looking at those same numbers, but looking at it with an eye towards analyzing what costs really change when sales go up, or what costs don't go down when sales go down. So the easiest way to understand cost accounting would be this. I'm selling shirts. If I sell a shirt for $20, it costs me $10. If I sell one shirt, it costs me $10. If I sell two shirts, it costs me $20. Okay, so the cost of the shirt varies directly with my sales. Now, whether I sell two shirts or one shirt doesn't change the rent I'm paying on my building. That rent is the same number every month, whether I sold one shirt or 1,000 shirts. I'm paying for that space, and that space cost is not directly related to my sales. It's a function of my space. Okay, so some costs directly vary with sales and some don't. IRS requires in certain manufacturers that the overhead costs, the fixed costs, the ones that don't vary, be applied to the product cost. And that's an overhead rate. The only way you can create an overhead rate is first to estimate your sales volume so you can then allocate a certain percentage of your fixed costs per sales. And then that allocation becomes the standard cost. And if you hit your number, you're right on, you'll be right on. If you sell more, then you've overcharged your overhead or overapplied your overhead. Or you underapply, you haven't covered your overhead. Let's continue with this shirt example and describe a break-even point. How many shirts do I have to sell to cover the rent? If if I'm selling a shirt for $20 and it costs me $10, I have a $10 contribution to my overhead from that sale of a shirt. If my overhead, my rent, is $2,000 in a month, I need to sell 200 shirts to cover that $2,000 before I have any profit. So at that point where it covers the $2,000, that's my break-even point. And after that, my contribution margin, my $10 becomes profit. When I sell the next shirt, I have my 201st shirt, I now have $10 of profit. I didn't have profit until then. So how often should you run financials? At least once a month. You get your bank statement once a month, you can reconcile your bank statement and you know those numbers are good and everything's included. So at that point in time, you can say, are my invoices in? Are my bills in? Is the bank reconciled? And you can run a report that may not be 100% accurate, but it'll be 100% timely. And 95% and timely is better than 100% and late. Do you need an accountant to review your financials with you? Maybe if you're new, I do that maybe once a quarter for the first year and see if he's got insights in your business that you haven't seen. He's going to be more familiar in how to read those statements and draw valuable information out of them. He's not the one running your business, but he can help you see what's happening from that viewpoint. Inventory is goods I've purchased for resale. Inventory is how I make if I'm selling inventory to make profit, that's how I make my money. So if I'm selling tires, if I buy 10 tires, they're inventory until the time I sell it, at which point the tire I sold becomes a cost of goods sold. So if you're running an inventory, if you're making money by sale of a product, you should be maintaining an inventory. Fixed assets are items I've purchased that have a benefit exceeding 1 year. The IRS has given us guidelines on acceptable lives, but for instance, computers and cars are 5-year properties. So if I'm buying a computer, I record it as a fixed asset and I expense it through depreciation expense over a 5-year period. Accounts payable are the expenses I've incurred but haven't paid yet. I record it as a bill and then later I pay the payable off out of my checkbook. Payroll shows up in 2 places on your chart of accounts. It shows up as a liability for the amounts that you're withholding from your employees, and it shows up as an expense, and what you pay your employees to produce for you. As an employer, you have responsibilities. You're actually held to a higher standard as an employer for the monies you've withheld from the employee. You're in a fiduciary position, and that's where the IRS gets even nastier about collecting payroll taxes than they do on collecting income taxes. Payroll taxes are not dischargeable in bankruptcy, and they can pursue you as a responsible party outside of the corporate liability. As an employer, you are required to withhold from pay to an employee based on a W-4 that they give you. If they don't give you a W-4, you're required to withhold on a single zero status, a single with no exemptions.